The banking industry is well regulated and highly competitive. Allianze Bank is one of the local banks that has built a strong position through its customer-focused approach. Allianze Bank Malaysia Berhad was established in 1982 and adopted its current names in 2001 after a major merger. The bank is listed on the Bursa Malaysia and offers both conventional and Islamic banking service through its subsidiary, which is Allianz Islamic Bank. The bank is governed by a strong corporate governance structure, overseen by board of directors and key committees such as audit, risk management, and Sharia committees. Its main business segments include consumer banking, SME banking, corporate banking, financial markets, and Islamic banking. In terms of performance, for the financial year ended 31 March 2024, Allianz Bank recorded over 2 million ringgit in revenue and around 690 million in net profit. Key indicators such as return on equity and capital ratio shows that the bank is financially stable and well managed. Strategically, Allianz Bank focused on SMEs, digital innovation, and communities engagement. Under Accelerate 2027 strategy, the banks aim to grow its consumer and Islamic banking, strengthen digital capabilities, and promote sustainability. Overall, Allianz Bank is a strong example for evaluating banking performance, risk management, and strategy decision making in Malaysian financial system.
Allianze Bank Malaysia Berhad offers a wide range of banking products and services for individuals, SMEs, and corporate customers. The bank's main product include savings and current accounts, fixed deposit, various loan and financing facilities, credit cards, and digital banking services. In terms of features, Allianze Bank provides secure banking products with competitive interest rates, flexible repayment terms, and convenient access through online and mobile banking platforms. These products benefit customers by making daily transactions easier, offering stable returns through fixed deposit, supporting personal and business financial needs, and improve efficiency through digital banking. However, there are also some drawbacks such as low returns on saving accounts, lock-in funds for fixed deposit, long-term loan commitments, high credit card interest charge, and potential cybersecurity risks. Overall, Allianz Bank offers a balanced mix of traditional and digital banking solutions.
So digitalization has significantly transformed the banking landscape by changing both customer behavior and internal banking operations. Today, customers prefer using a mobile and online banking platform rather than visiting a physical branches. In response, Allianz Bank introduced a digital platform such as Allianz Online and the B-Smart mobile app, allowing customers to perform transactions including fund transfer, bill payment, and account management anytime and everywhere. This shift has increased customer expectation for fast, secure, and user-friendly banking services, with a digital channel becoming the main medium of interaction between a customer and the bank. At the same time, digitalization has strengthened the Allianz Bank internal process by reducing reliance on manual procedure. The implementation of eKYC system and automatic process has enabled faster account opening and loan application approval, leading to lower operational costs and improved staff productivity. As a result, the role of physical branches has evolved from transaction center into the financial advisory hubs focused on customer relationship building. This operational transformation has made Allianz Bank more efficient, flexible, and better prepared to face modern banking challenges. Beyond the bank itself, Allianz Bank digitalization effort have contributed to developments of a Malaysian digital financial ecosystem. Digital banking initiative promote a financial inclusion, particularly for small and medium enterprise, which is SME, by offering more accessible digital financing solution. Furthermore, the rise of digital banking has encouraged greater technological innovation across the banking industry. With a strong support from Bank Negara Malaysia (BNM), digitalization continue to play a vital role in enhancing financial stability and strengthening the competitiveness of Malaysia financial sector.
Now I will explain the profitability performance of Allianz Bank by looking at 4 key financial ratios. First, return on equity or ROE. ROE increased from 9.44% in 2024
two key indicators are analysed, which are loan to total asset and liquid asset to total asset. Firstly, in FY 2024, Allianze Bank allocated approximately RM68.43 of loans for every 100 ringgit of total asset. This reflects the bank's strong focus on its core financing activities while maintaining a balanced asset structure. In FY 2025, this ratio increased to RM70.15, indicating a more aggressive financing strategy aligned with the bank effort to enhance profitability. However, this growth may also increase liquidity risk if asset expansion continue to be driven mainly by loan growth. Secondly, in terms of a liquidity asset, Allianze Bank maintained around RM5.44 of liquid asset for every 100 ringgit of total asset in FY 2024, indicating a good and sufficient liquidity position to meet the short-term obligation. The ratio slightly declined to RM5.36 in FY 2025, which suggests effective liquidity management, possibly due to increased loan withdrawal and optimizations of excess cash. Despite the decrease, the bank liquidity position remains stable, showing a continuous balance between liquidity and profitability. Overall, the findings indicate that while Allianze Bank adopted a more aggressive lending strategy, the bank continued to manage its liquidity prudently, maintaining stability despite higher liquidity exposure.
I will present the asset quality of Allianze Bank Malaysia Berhad for financial year 2024 and financial year 2025. Asset quality shows how healthy the bank's loan portfolio is and how well credit risk is managed. For this analysis, three key ratios are used, which is non-performing loan to net loans, loan to deposit ratio, and deposit to shareholders fund. Non-performing loans refer to loans that are not repaid according to the agreed terms. In the bank's financial statements, NPLs are reported as net impaired loans. The NPL to net loans ratio decreased from 1.07% in financial year 2024 to 0.94% in financial year 2025. This indicates an improvement in asset quality as fewer loans became impaired relative to the bank's total net loans. The decline reflects better credit risk management and improved loan performance. The loan to deposit ratio measures how much of customer deposits are used to fund loans. The ratio declined from 96.96% in financial year 2024 to 94.69% in financial year 2025. This shows that deposit growth outpaced loan growth, which strengthened the bank's liquidity position. Overall, the bank maintained efficient lending activities without creating liquidity pressure. The deposit to shareholders fund ratio measures how many times customer deposits are supported by shareholders' equity. The ratio increased from 6.7 times in financial year 2024 to 7.38 times in financial year 2025, mainly due to higher deposits. Although the ratio increased, shareholders fund continued to provide adequate support for deposit mobilization, indicating stable capital strength. Overall, the bank's asset quality improved from financial year 2024 to financial year 2025. Allianze Bank demonstrates sound asset quality and effective risk management over the 2-year period.
For this slide, I will explain the bank's capital adequacy, which refers to the bank's ability to absorb financial risk using its available capital. Capital adequacy is measured using the capital to risk-weighted asset ratio, or CRAR. This ratio shows how much regulatory capital the banks hold for every 100 ringgit of risk-weighted asset, and it is important to ensure financial stability and protect depositors. In 2024, Allianze Bank recorded a CRAR of 18.15%. This means for that every 100 ringgit of risk-weighted asset, the bank held 18 ringgit and 50 cents in total regulatory capital. This indicates a strong capital position and is well above the minimum regulatory requirement. In 2025, the CRAR slightly decreased to 17.05%. Although there was a small decline, the bank still maintained a solid capital buffer with 70 ringgit and 5 cents of capital for every 100 ringgit of risk-weighted asset, showing effective risk management. Next, we look at core capital, also known as Tier 1 capital, which represent the bank's strongest and most reliable form capital. In 2024, the core capital stood at 14.15%, meaning 14 ringgit and 50 cents out of every 100 ringgit of risk-weighted asset was supported by Tier 1 capital. For 2025, the core capital ratio slightly decreased to 13.062%. Despite this reduction, the level remains strong and reflects a stable capital base. Overall, although there was a slight decrease in both ratios from 2024 to 2025, Allianze Bank continues to maintain a healthy capital adequacy position, demonstrating financial resilience and the ability to withstand potential risks.
Next, management soundness. Formula for administrative expenses to total expenditure is administrative expenses divided by total expenditure. Administrative expenses to total expenditure on 2024 is 8.88%. In 2024, Allianze Bank recorded an administrative expenses to total expenditure ratio of 8.88%, indicating effective loss control. The low ratio suggests sound management efficiency in managing administrative and overhead expenses. Administrative expenses to total expenditure on 2025 is 6.88%. In 2025, Allianze Bank recorded an administrative expenses to total expenditure ratio of 6.88%, reflecting strong loss control. The lower ratio indicates improved management efficiency in controlling administrative and overhead expenses. In conclusion, the financial performance of Allianze Bank Malaysia Berhad for the financial years 2024 and 2025 reflects a stable and well-managed banking institution. The bank demonstrates consistent profitability, stable liquidity, improved asset quality with a lower non-performing loan ratio, and strong capital adequacy above regulatory requirements. Additionally, the reduction in administrative expenses to total expenditure indicates improved management, efficiency, and effective cost control. Overall, Allianze Bank's prudent risk management, operational efficiency, and strategic focus on digitalization position the bank well for sustainable growth in Malaysia's banking sector.